Basically, we are talking here when I say option, primarily currency option, which is dollar rupee. Of course, options exist on euro rupee, GBP INR, JPY INR, all of those are possible. But this session will conduct primarily based on dollar rupee currency pair. Now, options are of two types. One is a call option and a put option. And most of you will know that, right? A call option basically is something in this context is a right to buy dollars. And a put option is but if you buy a call option, you have a right to buy dollars. If you buy a put option, you have a right to sell dollars, right? There is something which is very basic. And an option has a right, meaning if you buy an option, you have a right, but you don't have an obligation. Meaning on the day the option expires, if spot rate is more than, let's say, the rate at which strike rate, the rate at which you have a right to buy, then you can exercise the option and buy it at the strike rate. But on the day, if the spot rate is below that strike rate, you don't have an obligation to buy. So you're open to market. You are free to not exercise the option. So options therefore are very flexible that way, and which are very, very useful to corporate hedging, especially because of this feature that you don't have an obligation. So you can structure it in such a way that your view is laid out. So what are some basic things? So call option and a put option, right? This is the first thing. Call option is right to buy and put option is right to sell, and no obligation, right? Now, unlike a forward, in a forward, there is only one rate that you have to buy or sell it. If you buy a forward, that means that for that maturity, the forward rate is determined. But for an option, you can choose a strike rate, right? You can choose the rate at which you will exercise the option, and that is called a strike rate. Now, this strike rate obviously can be chosen depending on the cost. So higher the strike rate for a call option, meaning the right to buy being higher and higher, the cost of the option or the premium of the option will be coming down. Right to sell for a put option, higher the strike rate, right to sell at a higher rate means it's costlier. So depending on the premium, you can figure out the strike that you want, right? Market basically have some conventions. ATMS strike is basically where strike is equal to spot rate of the trade. Basically on the trade date, whatever is the spot, if you use the same strike rate to buy for the option, then it's an ATMS option. If you use a strike equal to forward of that forward rate on that day at that time, then it's a ATMF option, at the money forward, right? These are the terminologies that we typically use. ATMS, ATMF, right? Now, again, another difference between forwards and options is that, option has two relevant dates. Meaning in a forward, there is only one day. If you are buying a forward for 31st December 2023, then that means on that day, the actual delivery of dollars and rupee will happen, right? But an option, because you have to exercise the option, you have to have two dates. One, the date on which the actual exercise happens, that is called the expiry. And 2 days after that, there is a settlement date on which the actual cash flow will happen, the delivery will happen. So optionality expires on the expiry date, and then the actual delivery happens on the delivery date, right? And finally, in dollar rupee market, most of the options that you see are European options, meaning the actual exercise can only be done on the last day or the expiry date of the option at 11:30 a.m. India time or 3 p.m. Tokyo time. So these are the features of an option, that it has a strike rate, it has an expiry date and a delivery date, and it has the right but no obligation, and hence it has a premium. And finally, it expires on a particular time on the expiry date at 11:30 a.m. India time, and an option has a premium that you have to pay, right? So this is the basic features of an option, just to give you a base from which we can talk about option structures.